Good afternoon. I'm John Mousseau. I am the President, CEO, and Director of Fixed Income here at Cumberland Advisors. It is Friday afternoon, February 5th. Bond yields this week higher. 10-year bond yield went from about a 107 to a 119. 30-year Treasury bond went from about a 183 to a 196, both double-digit climbs in terms of basis points. Really up 30 basis points pretty much in the 10 and 30 year since the beginning of the year. Why? Continued perception that there will be more spending in the economy. We saw Congress pass the spending bill last night. We'll see what form it finally takes with some wrestling. But clearly the markets are expecting more stimulus. That will eventually lead to higher interest rates. Stock markets continue to be positive. My colleague Matt's talked about that. All of this is a general trend higher in rates. If we saw this week, we saw the jobs number this week and the unemployment number. We saw good news, bad news. Good news is the market got basically 49,000 new jobs. Bad news is the market was expecting 109,000 jobs. But it was positive, and that was after a negative month last month. So we'll take some solace in that. We also take solace in the economy doing better as the difference between 2-year and 10-year bond yields continues to get wider, from 95 to about 105 basis points this week. That's up significantly since the beginning of the year. So a positive yield curve where the markets demand higher yields the further out you go in maturity, that's a positive sign for the economy. It's a market that expects the economy to continue to grow. Municipal bond yields flat this week, even in a week where you had rising Treasury yields. We talked about this last week. That is our thought, that you see bond fund flows coming in, demand for munis strong, and expectations of tax rates rising eventually. And we would agree with that assessment as well. Next week, we will be looking at CPI. Again, we don't expect CPI to go roaring ahead, but we expect it to pick up. And as we get further in the spring, it's pretty easy to see why it picks up, because you're going to be replacing last March and April numbers, which were dismal. We saw declining prices. We're going to be replacing those with some positive prices. And so those 12-month sequences, how we get CPI, you'll be taking out negative numbers and replacing them with positive numbers. So we do expect to see inflation start to pick its head up a little bit. Look forward to seeing you next week, and have a great weekend. Thanks a lot. Just a quick promo. I will be doing the Money Show on February 16th. It'll be about a 2-hour sequence in which I'm discussing the bond markets really through the pandemic, through the elections, to where we are now and where we expect to see ourselves going forward. And certainly that has been a long, strange trip on interest rates when you look at going from the mess of last March to where we are now, looking at a heavily vaccinated economy, we hope. So hope you join us for that. Thanks a lot.
Hi, Matt McAleer, February 5th, just after the close. Busy week, great breadth, small cap strong, mid cap strong, large cap strong, growth strong, value strong. Sector strength really across the spectrum, maybe a little more on the growth side versus the defensive side, although we saw a bid in some of the dividend names later in the week. Many emails and some calls on our video from last week. We had kind of a fun video talking about some of the headlines we saw last week, which you couldn't miss, about GameStop and AMC theaters and a handful of names that the shorts got run over in, and we talked about last week. Their own fault, lack of risk-reward recognition, getting caught in a scenario where they did not respect, how crowded their position was, thought they could work their way through that, couldn't do it. Opposite this week, right? As those shorts got taken out, all that built-in demand that a short provides evaporated. So you saw really a waterfall price action in those same names. And it gets back to what we talk about and have for the last 2 years now on these videos, and that's controlling your emotion, controlling your position. You know, Jesse Livermore, who many people have read, specifically traders, but investors as well. Jesse was a speculator in the 20s and 30s, had tremendous success and tremendous failure, and had some great quotes, one of which was, "There's nothing new on Wall Street. What happens today has happened before and will happen again in the future." And that is a real important quote to keep in mind. What we saw last week happened in 1999 and 2000. AOL message boards, Yahoo message boards. There was RagingBull.com. I don't know how many people were trading at that time. Ran stocks up 300, 400, 500% on regular intervals. So this isn't something new. Just keep in mind that risk reward and your ability to recognize that your opinion doesn't mean anything to the market is of the utmost importance. Remember, the market takes 1 million different opinions, hopes, dreams, fears, greed, emotion, and boils it down to a price. And that's all that matters. Price is king in any market, whether it's fixed income, commodities, equities. What my opinion is of where something should trade isn't important. My position has to be dictated on where I have the ability to hang with a trade or where I have to tap out and protect capital. When we have strong opinions, strongly held, you know, I know this is going higher. I know this is falling apart. I know this. I know that. That's when you run into trouble. You know, making money in the market, having successful trades, being profitable is not difficult. Keeping it can be. You know, emotion is always your enemy in trading. Another thing we talk about, right? Your biggest obstacle to successful, consistent trading is looking at you right in the mirror. And you may go back to March and think about that. Were you a little too emotional? These are things I ask myself. These are things we talk about within Cumberland. What should we have done better? What did we do very well? And we try to repeat the successful pattern. What we find is over years, over the course of market cycles, the more we can control our opinion, the better we do. So strong opinions, strongly held, always get you in trouble. There's an old saying, and I use parlance of the trading desks just from having worked with folks for 25, almost 30 years now. And if some of these terms and words are confusing, email me, call me up. But there's an old term that I quote that I keep right on one of my screens. And it says, strong opinions weakly held. Strong opinions to have conviction in your trade, weakly held in that if the price action doesn't back up your trade, you recognize that. So seeing a lot of people digging in their heels on different opinions right now probably isn't going to end well. They need to learn that. One final thing, an email if you know this or can answer this for me. Who the heck is the man on Wall Street? I keep reading these quotes from investors and traders that they're sticking it to the man. Confusing. The most transparent, open, liquid markets in the history of trading are in front of us today. Nobody makes anybody buy a stock, sell a stock, hold a stock. I can buy whatever I want. I can sell whatever I want. Now, fortunately, I do that for myself, but also for clients. Those clients put confidence in our opinions. But in terms of some of these headlines, they're humorous. We're talking about a situation in the investing and trading world that's unprecedented. Complete freedom to sell and buy and do whatever you'd like with your capital. And there's a man controlling all this? Come on. Stop with that nonsense. Focus on the markets. Focus on your capital. Have a great weekend. We'll talk next week.